Okay, so for part two, we're going to get into the rules and why we have to do things a specific way in accounting so that we end up with those reliable, relevant, and comparable financial statements. The first one we're going to look at is called Generally Accepted Accounting Principles. This is abbreviated by calling it GAAP, so you'll hear this throughout accounting, but the GAAP has those principles that tell us how we're going to record that information. Again, we want to make sure that it's reliable and that people can trust the information that we're presenting. We want to make sure that it's relevant so that people can make decisions from it. And we want to make sure that it's comparable so that if we have different companies being compared, we know that it's been prepared the exact same way. So we're going to use those principles to guide us in that. So GAAP is a US-based accounting. But we all know that many companies now are not operating just in the United States, they're operating globally. So there are standards for international, and they are called International Financial Reporting Standards, or IFRS. And they're similar to GAAP, but they're not the same yet. We do have some concessions that have been made between the International Accounting Standards Board, or IASB, and they are the ones that create the International Financial Reporting Standards. And then in the United States, we have the Financial Accounting Standards Board, or FASB, and they create the framework for the United States GAAP rules. So the FASB and IASB are working together to reduce the differences between US GAAP and the International Financial Reporting Standards. But right now, typically what the differences we see is that the International Financial Reporting Standards are a little more strict, where GAAP has a little more leniency. All right. So again, the concept, whether it's in US or international, is we're trying to get that guide so that we know how to prepare information. So the framework consists of objectives that provide information that's useful to our investors, creditors, and others. We want to make sure that it has qualitative characteristics that require information to be relevant, reliable, and comparable. We want to make sure that we have clear elements to define items that financial statements can contain. And we want to make sure that there's recognition and measurement. We want to have clear criteria that an item must meet for it to be recognized as that element that's listed above. And we want to know how we can measure that element. So that's the concepts that we've set up, that have been set up through FASB and IASB. This is just a summary to kind of show you the same in a pictorial. All right, so let's get into how we're going to operate in accounting. And I told you we're going to look at principles, assumptions, and then we're also going to look at a couple of constraints. So this one kind of gives us the overview. So we have general principles. They're the assumptions, concepts, and guidelines for preparing our financial statements. And then we're going to have specific principles that are detailed rules that we use when we're reporting transactions and events in our company. So let's first look at the 4 accounting principles. The first one is called the measurement principle, and more commonly it's actually called the cost principle. And what it tells us is that we're going to record information based on what we actually pay for it. So for example, let's say we bought a truck to operate our business, and we paid $30,000 for that truck, but it's worth $50,000. The value is not what we record it as. We record it for the actual cost that we pay for it, or the historical cost. So the amount that we actually pay is what we're going to record. Same thing if it was a service that's being provided, whatever was paid for that service is what we're going to record that value at on our books. We want to look at the next one, and it's called the revenue recognition principle. And there's 2 concepts that are important for this one. So first, to recognize revenue earned in the company, it is considered earned when the services are complete or the goods have been provided to the buyer. The other part is that it's recognized at the amount that we actually expect to receive. So the amount that's received in cash is what we're going to record that revenue for. Or if we've allowed them to pay on credit, the amount we're actually charging them, that's the revenue that we're going to record. But the key for revenue recognition is that revenue is earned when the job is done. So whether that means providing the service and it's done, or providing a good and that's been provided to the customer. The next one is called the expense recognition, or also called the matching principle. So that means that when we're recording our transactions, we want to make sure that we include the expenses that went along with the revenue we incurred. So we might have, we might have provided a service to a customer. And along with that, we had expenses to be able to provide that service. So let me give you an example. If we have a lawn service, we're going to cut someone's lawn. We had revenue that we earned from that. But to earn that revenue, we had to use gas for our mower. So we have a gas expense that was used in conjunction to earn that revenue. So we should be recording that expense in the same time period as the time we're recording that revenue. So that's what the matching principle says. So we're going to record expenses and revenue in the same time period that are tied together. And the last principle is called the full disclosure principle. So this one is where we're making sure that the company reports details that would impact a user's decisions. So a lot of them are going to be reported in something we call notes to the financial statements. So we want to make sure that we're disclosing anything that would make someone make a different decision based on our operations. All right, let's get into the accounting assumptions. All right, so the first one is called the going concern assumption. This one basically says that we're going to operate our business as if it's going to continue operating. So some years you might have really bad times and you might think, you know what, I'm going to have to close this business down, or we might have to sell it. But you're not going to operate your business any differently day to day. You're going to assume that it's going to continue operating day to day, even if it's a bad year. You're not going to change how you record things based on the thought that you're going to go out of business. The next one is called the monetary unit assumption. And this just tells us that we will only record accounting information that can be expressed in monetary units. In the United States, those monetary units are called dollars. So we want to make sure that we're recording in our books in the same monetary unit. So we always going to record in dollars in the US. And that doesn't mean that we don't have other currencies we would use in other countries, but we would have to convert it to US dollars to be able to put it on our GAAP statements. The next one is the business entity assumption. And this one's really important because we do see a lot of times people try to combine personal and business expenses, and that's not how it works. So the business entity assumption says that we are going to account for the business separately from how we account for our personal transactions. So if it's a business expense, we're going to record it with the business. If it's personal, we're not going to list it in the business transactions. So only things associated with a business get listed in the business's financials. The last one is called the time period assumption. And this one is telling us that we're going to divide periods of the company's operations into, it might be months, it might be years, and that's going to allow us to run reports or prepare reports for those specific periods. So we might, start a business in January. At the end of January, we want to see how we did. So we're going to be able to run a report for the month of January, but we're going to run it for those dates, January 1st to January 31st. So that the next time we want to see, well, how do we do next January? We have a specific time period that we ran it for. And we're dividing it into, it can be months or it can be years. All right. The next thing we want to look at is accounting constraints, and there are two of them. So the first one is called the cost benefit constraint. And this basically tells us that we are not going to engage in something that is going to cost us more than it's going to benefit us. And a great example of this is security. So, a lot of companies want to invest in security for their business, and that's important. But you don't want to pay more for your security than you're risking losing. So let's say you had a $100,000 business, but for you to have security for the business, it was going to cost you $120,000. Well, then the benefit is outweighed by the cost. So the cost is more than what you're getting as that benefit. So we would not choose to go through with that decision. If you choose to, if there's some reason, that needs to be disclosed as to why that decision was made. The other constraint is called the materiality constraint. And this basically says that, we are going to only worry about information that's going to influence the decisions as far as disclosures. So when we think about that, materiality comes into play when you're thinking about, you're recording supplies in your account. When we're counting supplies at the end of the month, we're not going to go through and count every single paper clip. We're going to assume we have a full box of paper clips or we have an empty box. We're not going to go through and count individual paper clips because that's not material to our business. That cost doesn't matter if we're off a little bit that way. So you want to only make those decisions based on what is actually material to your company. All right, the next part I want to talk about is different types of companies that we can have. And I can tell you for accounting 1, we are going to be focusing on what we call a sole proprietorship. So a sole proprietorship is when you have one owner. They're easy to set up. They're not a separate entity from its owner. So if the company were to be sued, that owner risks losing their personal assets as well as company assets. But there's a table here, and it's also in your book in Exhibit 1.8 that I encourage you to look at. And it talks about what sole proprietorships are, what their owner liability is, how they're taxed, if they're a separate legal entity or not, and how long their business lasts. Like, what is their business life? So sole proprietorship is what we're going to focus on in accounting 1. In accounting 2, we're going to get into talking about the other 3. We're going to talk about partnerships, where it means it's 2 or more people. We're going to talk about corporations. We might talk about C corporations. We might talk about limited liability companies, but we're going to get into that. So the gist for it to understand now is that sole proprietorships are 1 or more owners. They have unlimited liability, which means that they can lose their personal assets. Partnership is 2 or more. They also have unlimited liability. A corporation, however, its owners are the stockholders. So anyone that owns stock in that company or shares in that company is going to be considered an owner. But the difference is they're not personally liable. The only thing they risk losing is the amount they invested in that company. And then the last one, limited liability company, it can be 1 or more members, and a lot of times you're going to see a sole proprietorship, so it's 1 or more, 1 owner, and they're going to form as that limited liability company so that they can protect their personal assets. So that means that the person's not personally liable for the LLC's debts, but it is a separate entity with the same rights and responsibilities as a person. All right, so that's where we're going to stop for part 2, and we're going to get into the next section where we're going to talk about the accounting equation and the different parts that go along with it, and we're going to get into some major terminology. So we'll get continuing in part 3, looking at the accounting equation and its components.